accounting rules have changed for leases. FASB issued updates to the lease accounting standards. Originally, they were governed by FASB ASC 840. They're now governed under FASB ASC 842. And what FASB ASC 842 does is goal is really to increase the disclosure and visibility of an organization's leasing obligations, and also ensure financial statement comparability amongst all organizations by requiring lease obligations to be recognized on the balance sheet or equivalent statement. For example, if you're not-for-profit, that would be the statement of financial position. The operating leases are now reflected on the balance sheet as a right-to-use asset and liability, and capital leases are now called finance leases. There is an additional criteria for determining what a finance lease is. Criteria is the alternative use test, and within the rules, there are explanations as to what that means. In addition, deferred rent expense payable will be included within the right-to-use liability for operating leases. So there won't be a separate line item on the balance sheet. It'll all be rolled into that right-to-use liability. In terms of calculating the lease, finance leases are based upon present value of future lease payments and may be affected by different inputs, and the new rules go into what inputs may affect the calculation. For example, interest rates, residual guarantee or use limits, options to renew, and etc. The right to use liability is calculated the same as a finance lease, but it may also be affected by different inputs, and those inputs are also listed in the new rules. In terms of amortizing or expensing the leases, the right to use lease is amortized on a straight line basis over the lease term, and whereas a finance lease, because it's capitalized, the expense is recorded as interest expense, portion of it, and another portion is actually recorded as amortization expense to offset the asset that's been calculated and recorded on the books. Embedded leases are categorized as right-to-use leases and may be affected by additional charges like taxes, utilities, maintenance, and things of that nature. So you do want to look at any embedded leases and things that are included within leases to make sure that the lease asset and liability are being calculated properly. And if there's any variables that get included in the calculation of those embedded costs, they may not be included in the calculation of the right to use asset or liability. So you have to really look at the individual agreement and come to a determination if those costs should be included in the calculation or not. Changes to lease terms or rent concessions in the middle of a lease may also affect the calculation of the right to use asset, and usually that would be accounted for as a change in estimate. The adoption of the standard may drastically change the balance sheet, or if you're a not-for-profit, statement of financial position. So you do want to make sure all third parties who are interested in the financial statements are communicated with and aware of any potential changes that the adoption of this standard might have on the financial statements. And again, the adoption of this standard is really out there to make the financial statements more transparent in terms of what an organization's actual cash obligations are. And that's being done by requiring all leases to be recorded, as a liability on the books. And if you want more information, you can follow us for any accounting updates, and please reach out to us. Thank you.